Welcome back to MonsterInvest. I am your host, Daniel. Close your eyes for a moment. I want you to imagine you are standing in the middle of a vast, ancient marketplace. The year doesn't matter. It could be ancient Rome, it could be Wall Street in the 1920s, or it could be a digital exchange in the cloud today. The noise is deafening. People are shouting, bells are ringing, and money is changing hands at the speed of light. But if you look closely, amidst all this chaos, you will see that the crowd is actually divided into two very distinct tribes. They don't speak the same language, they don't look at the world the same way, and they certainly don't agree on what makes something valuable. On one side of the marketplace, you have the dreamers. They are looking up at the sky. They are shouting about ships that will sail to the moon, elixirs that will cure all diseases, and machines that will do the work of 1,000 men. They don't care about what is happening today. They are obsessed with what might happen tomorrow. They are loud, they are exciting, and they draw a massive crowd. On the other side, far away from the noise, you have the accountants. They are looking down at the ground. They are inspecting the bricks of the buildings, counting the coins in the register, and measuring the inventory in the warehouse. They don't care about dreams. They care about what they can touch, hold, and sell right now. They are quiet, skeptical, and frankly, a bit boring. This, my friends, is the eternal battleground of the stock market. This is the war between growth investing and value investing. Today, we are going to dive deeper than we ever have before. We aren't just going to define these terms, we are going to live them. We are going to walk in the shoes of two investors, let's call them Arthur and Jenny, and watch how their lives unfold over a turbulent decade. By the end of this episode, you will know exactly which tribe you belong to and why your neighbor's strategy might drive you crazy. So get comfortable, grab your coffee, we have a long journey ahead. Let's start with the tribe on the right, the value investors, the tribe of the archaeologist. Value investing is often misunderstood. People think it's just buying cheap stocks or garbage companies, but it is much more profound than that. It is a philosophy based on the idea that the market is a manic depressive person, sometimes too happy, sometimes too sad. The value investor believes that eventually, reality always wins. Let me introduce you to our first protagonist, Arthur. Arthur is a man who doesn't like surprises. He drives a reliable sedan that he bought 5 years ago. He wears clothes that never go out of style. When he goes to the supermarket, he goes straight to the clearance aisle, not because he is poor, but because he hates the idea of overpaying. He demands $1's worth of value for every 50 cents he spends. It is the year 2015 in our story. The market is buzzing with excitement about new social media apps, cloud computing, and electric cars. Everyone is talking about the next big thing. But Arthur is ignoring all of that. He is looking at a company called Titan Industrial. Titan Industrial makes forklifts and cardboard boxes. It is the most boring business you can imagine. The company has been around for 50 years. It's not sexy, it's not changing the world, but recently, Titan has hit a rough patch. A global recession slowed down shipping, and their profits dropped by 20%. Wall Street hates uncertainty. The big institutional investors panicked. They looked at the short-term drop in profits and sold Titan stock aggressively. The price fell from $100 down to $40 in just 6 months. The news headlines were terrible. Is Titan Industrial dead? The end of the forklift era? Why old industry is doomed? Most people would run away, but Arthur sat at his desk, analyzing the financial statements with a calm demeanor. He didn't look at the headlines, he looked at the balance sheet. Here is what he saw. Titan Industrial owned 20 massive factories completely paid off. They had zero debt, and they had $1 billion in cash sitting in the bank, just waiting for a rainy day. Arthur pulled out his calculator and did the math. He realized that if you shut down the company today, literally fired everyone, sold the factories for scrap, sold the land, and paid off every liability, the cash left over would be worth $60 a share. Yet the stock was trading at $40. This is the holy grail of value investing. It is what Benjamin Graham, the father of value investing and mentor to Warren Buffett, called the margin of safety. You are buying a dollar bill for 66 cents. The downside is protected by the hard assets. Arthur buys the stock. He puts a significant chunk of his portfolio into this boring forklift company, and then nothing happens. For 2 years, the stock sits at $40. It barely moves. Meanwhile, Arthur watches his friends. They are making money in tech stocks, doubling their money overnight on companies that don't make any profit. They laugh at Arthur. Why do you own that dinosaur? They ask. Titan is dead money, Arthur. He feels stupid. He feels left out. This is the pain period of value investing. It requires a level of patience that borders on stubbornness. You have to be willing to look wrong for a long time in order to be right eventually. But Arthur has a secret weapon. Titan Industrial pays him a 5% dividend every year just for waiting. While the stock price is flat, the company is sending him checks from their cash pile. He takes those checks and buys more shares at the cheap price. Then in 2018, the economy turns. Shipping demand explodes. Everyone needs forklifts again. Amazon needs warehouses. Warehouses need boxes. Titan Industrial announces record profits. Suddenly, Wall Street remembers this company exists. The smart money rushes back in. The analysts upgrade the stock from sell to strong buy. The price goes from $40 back to $100 and then to $120. Arthur didn't predict the future. He didn't bet on a new invention. He simply bet that the market was emotional and wrong about the present value of the assets. He bought a dollar for 50 cents and waited for the market to correct its mistake. However, value investing isn't a guaranteed win. It has a dark side. It is called the value trap. Let's say Arthur gets confident. He finds another company later, a newspaper printing business. It looks cheap. It has low debt. It pays a huge dividend. It looks just like Titan Industrial. He buys it, but this time the stock doesn't bounce back. It goes down to 30, then 20, then 10. Why? Because the internet has fundamentally destroyed the business model of printed newspapers. The assets were there, but the future cash flow was going to zero. Arthur made the mistake of looking at the numbers but ignoring the narrative. That is the risk of the value tribe. Sometimes, things are cheap because they are actually broken. Sometimes, the market is right. Now let's leave Arthur counting his dividends and walk across the marketplace to the other side, the tribe of the futurist, the growth investors. If Arthur is an archaeologist digging for gold in the dirt, our next character, Jenny, is an astronaut aiming for Mars. Jenny doesn't care about what a company is earning today. In fact, if a company is making too much profit, she gets suspicious. She thinks, why aren't they reinvesting that money to grow faster? Why aren't they hiring more engineers? Why aren't they building more servers? Growth investing is about the power of compounding and the S-curve. It is the belief that a new technology or a new business model will fundamentally change the way we live, and the company leading that change will capture almost all the value. It is 2016 in our story. Jenny encounters a company called Neuralink Dynamics. Neuralink is a small, chaotic company. They are losing money, a lot of money. They are burning through cash to develop a new type of artificial intelligence chip. The financial statements look like a disaster scene. Arthur, our value investor, would take one look at this and run away screaming. He would say, they have no assets, they have only debt and dreams. But Jenny sees something else. She looks at the product. She sees that the smartest engineers in the world are leaving Google and Microsoft to work at Neuralink. She looks at the total addressable market, or TAM. She believes that in 10 years, every car, every refrigerator, every phone, and every robot will need this chip. She isn't paying for the company as it is today. She is paying for what it will be in 2026. She is paying for the possibility. She buys the stock at $50. Unlike Arthur's boring journey, Jenny's journey is a roller coaster. It is a psychological thriller. In the first year, Neuralink announces a breakthrough in their chip design. The stock doubles to 100. Jenny feels like a genius. She feels on top of the world. She calls her friends and tells them to buy. She starts looking at luxury cars. But then disaster strikes. A competitor announces a similar chip. A report comes out saying Neuralink is running out of cash. Panic sets in. The stock crashes 40% in a single week. It goes from 100 down to 60. Jenny's portfolio is bleeding red. She doubts herself. She can't sleep. Was I wrong? Is this just hype? Did I just lose half my savings? This is the pain period of growth investing, extreme volatility. To be a successful growth investor, you have to have a stomach of steel. You have to be able to separate the stock price from the business reality. You have to believe in your thesis so strongly that you can watch your money vanish by 50% and not sell, because you believe it will eventually go up 1,000%. Jenny holds on. She listens to the earnings calls. She tracks the adoption of the technology. She ignores the noise of the stock price and focuses on the growth of the revenue. Over the next 5 years, Neuralink begins to dominate the world. Their chips are in everything. They turn profitable. Their margins explode because software and chips are scalable. The stock that was $50 is now trading at $500. Jenny has made a 10-bagger, 10 times her money. This is the drug of growth investing. One big win can pay for 10 losses. It is life-changing money. But just like value, growth has a dark side. It is called multiple compression. Let's say Jenny gets overconfident. She feels invincible. She finds another company, a trendy electric scooter startup. The stock is trading at 100 times its sales, not earnings, sales. It is priced for perfection. The market assumes this company will grow at 50% every year for the next decade. Jenny buys in, but then interest rates rise. The economy slows down. The company is still growing, but just a little slower than expected. Instead of growing 50%, they grow 30%. Now 30% growth is still amazing for a normal company, but for a stock priced at perfection, it is a disaster. The market is unforgiving because the expectations were so high, a small disappointment causes a massive crash. The stock falls 80%. The company is still fine, they are still selling scooters, but the valuation, the price people are willing to pay for that dream, has collapsed. Jenny loses almost everything on that trade. So we have Arthur with his dusty balance sheets and steady dividends, and Jenny with her wild volatility and moonshot dreams. But there is a third character in this story, a character that controls the fate of both Arthur and Jenny. This character is the environment, the macroeconomic weather. You see, neither Arthur nor Jenny operates in a vacuum. The winner of this battle often depends on what the central banks and the economy are doing. Let me explain this simply, because this is the secret sauce that most beginners miss. Growth stocks like Jenny's AI company are what we call long-duration assets. This means most of their cash flow will come far in the future, 10 or 20 years from now. You are waiting for the pot of gold at the end of the rainbow. Value stocks like Arthur's forklift company are short-duration assets. They have cash right now. They are handing you gold coins today. When interest rates are low, money is cheap to borrow. It doesn't cost much to wait for 10 years, so future cash is almost as valuable as present cash. In this environment, like we saw from 2010 to 2020, growth stocks crush value stocks. Jenny looks like a genius and Arthur looks like a dinosaur. But when interest rates rise, the math changes. Suddenly, $1 today is worth much more than $1 in 10 years because you can put that dollar in a bank and get a guaranteed 5% return. Investors stop dreaming about the future and start demanding cash now. In this environment, like we saw in 2022, the bubble bursts. Jenny's high-flying tech stocks crash, and Arthur's boring, cash-rich companies suddenly become the most popular girls at the dance. Capital flees from risk to safety. So listening to this, you might be thinking, Daniel, this is all great. I understand the history, I understand the math. But which one am I? Which strategy fits me? To answer that, I'm not going to look at your bank account. I'm going to look at your personality. I want to put you through a stress test right now. I want you to answer this honestly in your head. Imagine you have saved $10,000. It is money you worked hard for. You invest it all in one stock. Scenario A, you wake up, check your phone, and the stock is up 100% in a month. You are ecstatic, but the next month it is down 60%. It swings wildly every single day. The news is always talking about it. Your mom is asking about it. Can you handle that? Can you resist the urge to sell at the bottom? Do you have the vision to hold for 10 years without seeing a single penny of dividends, trusting that the company is building the future? If you said yes, and if you are naturally optimistic about the future of humanity, you are likely a growth investor. You are a Jenny. You should focus on technology, biotech, and disruptive innovation, but you must learn to handle volatility. Scenario B, you invest your $10,000. The stock does nothing. It moves up 1 cent, down 1 cent. It is boring. Your friends are bragging about crypto and AI, and you are holding a grocery store stock or a bank. But every quarter, without fail, you get a check for $100. You look at the financial statements and you see that the company owns real estate worth more than the stock price. You sleep well at night, but you never get that adrenaline rush of doubling your money quickly. If you prefer this peace of mind and you love finding a bargain, you are a value investor. You are an Arthur. You should focus on industrial companies, banks, energy, and established consumer brands, but you must learn to avoid value traps. But here is the secret that the pros know. You don't purely have to be one or the other. There is a hybrid strategy. The legends like Peter Lynch used it. It is called GARP, growth at a reasonable price. It is about finding a company that is growing, like Jenny wants, but buying it only when it is trading at a fair valuation, like Arthur wants. It is about waiting for a great company to stumble and then pouncing. It is buying Apple not when everyone is cheering for it at the all-time high, but when everyone is worried about iPhone sales for 1 quarter and the price dips. It is buying Google when people are scared about regulatory lawsuits. It is the hardest strategy because it requires the optimism of a growth investor and the skepticism of a value investor combined. You need to be a dreamer with an accountant's brain. As we near the end of our journey today, let's take a step back and look at the big picture. Whether you choose the path of the archaeologist or the astronaut, the goal is the same: financial freedom. The only way to lose this game is to not play, or to play a game that doesn't fit your personality. If you are a nervous person trying to be a growth investor, you will panic sell at the bottom and lose money. If you are an ambitious, aggressive person trying to be a value investor, you will get bored, sell too early, and miss out on life-changing gains. Know thyself. That is the first rule of MonsterInvest. Now, before I let you go, I want to summarize the key lessons from this deep dive. If you were taking notes, this is the part you want to write down. Here is what you learned today. Number 1, growth investing is about the future. It focuses on revenue expansion, innovation, and total market potential. It works best in low interest rate environments and requires a high tolerance for volatility. The biggest risk is paying too much for a dream that never happens. Number 2, value investing is about the present. It focuses on assets, cash flow, and dividends. It involves buying stocks for less than their intrinsic worth. It provides a margin of safety and works well in uncertain economic times. The biggest risk is the value trap, buying a company that is cheap because it is dying. Number 3, macroeconomics matters. Interest rates act like gravity on stock prices. High rates hurt growth stocks more than value stocks. Always know what the weather is like outside before you choose your outfit. And number 4, your temperament is more important than your intellect. Choose the strategy that allows you to sleep at night. If you can't sleep, you will make mistakes. And in this game, mistakes cost money. We have covered a lot of ground today. We traveled from the dusty shelves of industrial warehouses to the shiny laboratories of AI chips. We walked with Arthur and Jenny. We saw them win and we saw them lose. And hopefully you found a reflection of yourself in one of them. Investing is a marathon, not a sprint. It is a lifelong journey of learning, adapting, and disciplining your emotions. I want to thank you for spending this time with me. Your time is the most valuable asset you have, more than any stock in your portfolio, and I appreciate you investing it with MonsterInvest. If you found value in this episode, if it gave you a new perspective or just clarified your own strategy, please do me a favor. Hit that subscribe button. Leave a comment below telling me, are you an Arthur or a Jenny? I read every single comment and I'd love to know who is listening. Stay curious, stay disciplined, and most importantly, keep investing in yourself. I'm Daniel, this is MonsterInvest, and I'll see you in the next episode. Goodbye.